Hi, I'm Grant Abbott and I'm from Smsf Strategies. And today we're looking at the importance of an investment strategy inside a family superannuation fund. So a lot of people give lip service to investment strategies, but they're a really important fundamental platform of the fund's underlying investments. The beauty about a self-managed super fund or family super fund, and really for anyone for that matter, and the real difference between these funds and a retail fund or an industry-based fund or employer or a public offer fund, is that these funds allow you to choose a wide range of investments. For example, you could choose artwork, wine, collectibles. You can have property in there, you can have land in there, you can have shares, private company shares, unit trusts, a whole range of investments from both within Australia and also outside Australia, of course, provided your trustee allows. Now, when you have that wide range, it really comes down to being, well, at one stage, at one level, and I'll talk about that, at the trustee level, a determination of, well, this is the way we want this family fund to go. We want to start to invest in here. For example, if you've got someone who's a trustee and they're a very successful and well-credentialed property developer, it seems to me to make sense that inside their family superannuation fund, that not only do they invest in property, obviously they're going to get a good deal there, but they may well want to consider commencing property development in there. I mean, that's their bread and butter. Why wouldn't they be doing that inside their self-managed super fund where there's inherent a wide range of tax benefits inside the fund? What I would suggest there is the same thing. If someone's a wine collector, avid wine collector, provided certain terms and conditions are met, we've got an ability there that wine can be stored, can be used inside the fund. Of course, you can drink, effectively you have a lump sum liquid withdrawal if you wanted, once you're over age 60 and able to access your benefits. But if it's a good wine collection, and you know what you're doing, again, it's a great opportunity to put that inside the fund. Share traders, there's a number of people who share trade. Well, it's another opportunity to start to consider, well, this is what we're good at, this is what we want to get involved with, and start to focus in on share trading inside the fund. Do what's fundamental to you. But just backing away, the legislation, and in particular section 52(2)(f) of the SIS Act, provides that the trustee of the fund must have a well-documented investment strategy that says, well, this is the way we're going. We're going to put this amount of assets, a certain percentage between in this particular asset class, and more importantly, this is how we're going to invest. You know, for example, if we're going to be share traders, we can't just simply say, well, we're putting 100% in cash, because that doesn't work. In fact, there's a number of penalties, very, very, very strong penalties for someone who doesn't have a well-documented investment strategy. You'd have to say, first off, not only are we going to put a certain percentage in shares, but we might say, well, we're going to run a passive share portfolio 40%. We're actively going to trade 20% of the portfolio in the share market. Likewise, with the new exciting opportunities being the ability to borrow inside a self-managed super fund, we have to work out how we're going to encompass that, or how we're going to bring that inside our investment strategy. How does it meld together? Now, as I said at the outset, there's the trustee creates the investment strategy. But let's back away and understand that these family super funds have a number of different members in them with different profiles. We could have some that have got children, for that matter, who are 30, 35 years of age, while their parents could be up around about 60, 65. They could be in retirement years, whereas their children are in the accumulation years. And you see that an investment strategy running across the whole side of the fund may not be appropriate. The parents might have a more cautious view of the market. They may have been burned by the recent fall in the stock market and not want to get into stocks. Whereas the youngsters, the 30, 35-year-olds who can't touch their underlying investments, their underlying superannuation benefits for 30, 35, even more years, they're going to be in a position of saying, well, hold on, we need to have a fairly aggressive portfolio. We don't need so much in cash. So for the trustee of the fund, generally it's going to be the trustees of the fund who really control the fund are the ones with the most benefits. They're going to be in a position of not wanting to actually have one investment strategy or one portfolio for the whole fund. They're going to want to segregate. In fact, one of the major problems that I've seen a number of advisors advise against these family super funds because of the investment strategy issue. They'll say, well, hold on, we're not bringing the kids in here because obviously the parents have got a different investment strategy. That's just crazy, because the easiest way to do it is have segregated investment strategies. The kids have their own investment strategy, and you can even segregate it further such that each member of the fund has their own investment strategy. So why segregate anyway? Well, here's a couple of important tax reasons. First off, on the pension side of the fund, any income or capital gains are basically tax-free. On the accumulation side of the fund, and remember we're looking at members, many members of the fund having different accounts. Mum and dad might have a pension and accumulation, and the kids might just have an accumulation. On the accumulation account, it's 15% on income and 10% on capital gains. Now, for example, if we've got an asset sitting on the accumulation side that's got a large capital gain, if we're running a pooled asset, then they're all joined together and we get a partial exemption of that capital gain. You look at a simple percentage, how much is in the pension side, how much is in the accumulation side, and then effectively we get an exemption for that portion that's in the pension side. Whereas if we've run segregated, it makes sense, doesn't it, really, when pensions actually need to take out cash, to simply say, well, hold on, we want to sell this asset, it's got a capital gain on it, get the trustees to move between investment strategies from the accumulation account to a pension investment strategy and then sell it. Because once sold there, effectively it's tax-free, even though a large amount of the capital gain is accrued from the accumulation side. Smart move of using segregated and separate investment strategies. So how do we effectively do one of these investment strategies to make sure that not only they deliver on the needs, they meet the segregated pooled, but more importantly, they meet all the compliance guidelines, not only in the SIS Act, but the wide range of Commissioner's rulings in relation to investment strategies? Well, one of the best ways is, of course, to utilise the SMSF Strategies Investment Strategy Service for individual trustees. This is available on our website and can be ordered directly or filled in directly, and it covers a number of areas including art, collectibles, property development, land, shares, managed funds, and really gives you a strong, comprehensive platform in which to base the investment strategy decisions inside the fund. And again, you can have pooled investment strategies or segregated investment strategies between members, between sides, or even between members' benefits. Alternatively, for advisors and accountants and financial planners, if you're looking again to deliver a solid strategic investment strategy platform for your clients, best thing to do is get the SMSF Strategies Advisor Investment Strategy Kit. We've got a special discounted offer available. Just have a look at the website and order it directly from the website. Anyway, investment strategy is absolutely key to making sure these family super funds run as fast as they can and meet all the compliance requirements of the Commissioner. It's Grant Abbott from SMSF Strategies, signing off.